Hello and welcome to the O'Hare Wealth Management 2026 Market Outlook. I'm Jerry Jones, a partner with O'Hare Wealth Management, and I'm excited to welcome you today. This is where we set the tone for the year ahead and also looking at the rearview mirror a little bit to talk about the year that was. Before we dive into that, I'd like to talk a little bit about our three core principles. These are the principles that have been driving our team for 15 years. This is our 15th market outlook, and John and JJ and I still believe in these three core principles as much today as we did when we first established them. First, we want to be your go-to advisor. Anything of a financial nature you have a question on, never hesitate to bring that to our attention so that we can work on that together. Number two, optimize your wealth. We want that money working as hard as possible to help you achieve the financial goals that all of us have established together. And three, and most important to me, service with integrity. We want to provide you five-star service with the utmost level of integrity while we do so. Now I'd like to briefly talk about our relationship with our two partners. It's been 5 years since our move over to Stewart Partners, and in association with them and Raymond James, it's been a fruitful relationship that has allowed us the utmost flexibility and the ability to manage our team as we see fit. First, Stewart Partners has experienced significant growth. If you look at this chart, 628 partners, 301 advisors, over 80 offices, and in such a short period of time, we have grown to number 9 on Barron's Top 100 RIAs for 2025. Likewise, Raymond James has experienced significant growth as well. Over 1.73 trillion in total client assets, more than 2 times the required total capital ratio, and a stable outlook of credit ratings from Fitch, S&P, and Moody's. And amazingly, 151 consecutive quarters of profitability. That is definitely something to be proud of and to hang your hat on. This relationship provides us the ability to provide you, our clients, the highest level of service and the utmost level of care. With that, I'm going to turn it over to my teammates. Welcome to our 2026 Market Outlook.
Well, let's jump right into the economic outlook. So I'm going to talk about the state of the economy as it is today, what we think unemployment, inflation, and the Fed are going to do as a result, and then what keeps the economy driving into the next phase. Let's start out with what GDP is. First of all, GDP is gross domestic product, but you measure it by the consumption, even though it's about the amount we produce. It's two sides of the same coin. If you think about this logically, it's a bit like a vegetable garden. If you have a vegetable garden and you grow 100 units of food, you can only eat 100 units of food, unless there's another person with another garden. And that's where the consumption is and the production is measured. So we measure it by the amount we consume, but we have a couple of different things we account for. One, housing. That's the almost 4%. Investment X housing, our businesses investing in America. State and local government spending, close to 11. About 6.5 is federal government spending. Most of the U.S. economy is measured through consumption of personal consumption. It's almost 68%. And at the bottom there, you've got net exports. And we are net importers, which means it's a negative number. So it means that we produce 94 and we import, and we actually still consume 100. So it's a net negative number to account for how much we actually produced. Because again, we measure production through the amount we consumed. Why is that important? Well, normally that number is pretty stable, but the last year we've seen a little bit of an influx here. Real GDP, and this number, I'm not going to zoom in on this one because I think it's pretty obvious. This is 2024 and 2025. We don't have fourth quarter numbers yet for 2025, but in Q1 we had a negative quarter, and people pointed to that and said, oh, this is terrible. Well, part of it was we saw a rapid increase in net imports. And why? Well, because we were on the cusp of Liberation Day. We thought that was coming down. And if everything was about to get more expensive, we saw people sort of try to front load and buy things today. Instead of buying a 1 month supply, people bought a year-long supply. Well, that was a net negative number. We saw record new amounts of imports that quarter. It drove down the overall GDP number because remember, it's a net negative. The flip side is also true in Q2. Guess what? If you buy a year's supply or a 2-year supply of something, you don't tend to buy it 30 days later. Or 60 days later, you tend to wait a year or two. Well, that being the case, we saw record low new imports. So actually, we saw sort of this change where the economy is probably overstated as a result of net imports and exports. But in Q3, it kind of went much more back to normalized numbers, and we still grew at about 4.3, and this chart is actually revised at 4.4%. It's a pretty staggering number. And to put that in perspective, when I say a staggeringly high number, we have to go to this chart. This is the long-term growth rate of GDP. I'm going to zoom in here briefly. This goes back to 2001. We've grown at about 2.1% gross domestic product in the last 25 years. And by the way, we've grown at like 2.5% since the 1970s, and really before that, like 2.5 to 3%. I mean, this is pretty common. As you get bigger, it's harder to keep growing at such a rate. But we typically grow at about 2.1%. We're growing at about 4.3%. The flash number from the Atlanta Fed, and they do a sort of a back of the envelope number that is usually revised later. They think currently we might be growing at close to 5.1%. That's an incredible surge. And if you look at this chart, you can see some big economic pullbacks. You can see the great financial crisis, which I'll be honest, if you look at this chart, doesn't seem that impressive. Even COVID's big spike down, quick recovery. The fact that we're growing at 4.5%, we don't usually see that unless we're coming out of one of those modes. Usually we're growing at closer to 2.1%. And a little bit above and a little bit below is kind of the norm. And a big pullback, is, we've had a couple of them that it wasn't even that big of a change. So when you look at growing at 4%, that's a really, really robust number, especially not coming off of a bottom like we did during COVID. We had big numbers coming out of the COVID recession, but we should, because we were trying to get back to even very quickly, and we had the room to do it. But I think if you ask the average consumer today, that's not the case. Now, I just got another one about consumer confidence today, hit a low going back over 12 years. This is consumer sentiment. How do consumers feel about the market and the economy today? We've made the case for years that this is a great measure if you want to look at when to invest. If you look at the dots on the bottom, that's when the economy is at its worst. Right? May of 80, that was the death of the equity. 1990, we were about to enter a recession. November of 2008, the bottom of the great financial crisis. August of 2011, right? You're looking at the European financial crisis. Not COVID. You have the extreme inflation in June of 2022. That's another bottom. And today, we're basically, the last reading says that we feel about as bad today as we did during the great financial crisis. Which I just want to put that in perspective. That's how people feel right now. Normally, when people feel their best, January of 2020 or 2000, right before the tech bubble burst, people feel great. People feel great in 2007, right before great financial crisis. People felt great in 2015, just in time to have 2015, 2016 go mostly sideways. People felt great in February of 2020, right before COVID hit. That's when you typically see highs. We're seeing really big lows. And to put that in perspective, November of 2008, you're talking about rapidly rising unemployment. You're talking about housing prices getting crushed. You're talking about economic destruction, and you're talking about equity values getting crushed. Almost none of that is true today. Really, none of it is true today. If anything, all those things are the opposite, and people still do not feel good about this economy. So normally you want to invest when people don't feel well, because things are typically underpriced, and if everybody feels great, typically things are overpriced. Right now, nobody seems to feel good, and this might be a broken measure, because people should ultimately feel good about a lot of the things that have happened as of late. One of the things I think might be a cause for this is this trend. This chart's a little old, and it's pretty obvious what's happening. It's going down. This is the share of U.S. manufacturing as a percent of GDP. It's been declining for 75 years, and now it's basically under 10%. Well, I think most people think manufacturing is a bigger part of the U.S. economy. I know people have talked about it shrinking over the years, but I think in their minds, most people still think, it's got to be like a third. No, it's under 10%. And that helps explain this chart. There's two things here. One, construction and manufacturing. So construction spending is that thin line. Let's zoom in here. You notice it's rose a lot from 1996 into 2007. Obviously, the great financial crisis made it harder to make those new investments. And then it bottomed and then started to take off again. The onshoring story is not new. The onshoring story is not even post-COVID new. The onshoring story goes back to like 2012, is that companies are willing to put things to invest here. And if you think about that, companies don't care about administrations or temporary setbacks. If you're doing real construction spending, right, and let's pick an oil refinery. An oil refinery is not concerned with the current environment. They're concerned with how much oil is going to be produced in that region for the next 25 years. Amazon does not put in a new distribution center because it's good right now. They put it in because they plan on having that distribution center for decades to come. That's what you see in construction spending. Construction spending is the attempt to try to make investments today that will pay off in the future. The ISM number is how is manufacturing doing? Is it growing or contracting? If it's under 50, which I'll zoom in again here, on the right-hand side, you can see it's pretty much been under 50 for basically since 22. So most of 22, most of 23, or all of 23, 24, 25, you're looking at almost 4 years of manufacturing contraction. And that doesn't seem to tell the same story. Well, it's because the long-term outlook is positive, but the short-term outlook has been relatively negative for manufacturing. So if you're in manufacturing, it feels like you've probably been in a recession for the last few years. It's been a contracting industry. Even though you're making all these new investments, those investments are forward-looking. And these two lines don't seem to move in tandem because they shouldn't move in tandem. One is a temporary trend and one is a long-term trend. But the onshoring story is here. Conversely, 70% of the economy, over 70%, is services. And why is that? Well, because making a plane is manufacturing. Sending it around the country to actually utilize it is a service. Making a computer is manufacturing. Utilizing it to better perform business tasks or using an AI-driven software is a service. So services are now 70%. That, you notice the dotted line, it's basically been above the dotted line for years. There's the temporary COVID setback, and there's been a few quarters where it dropped. And this isn't even the latest number. It's actually 54.4 right now. If 70% of the economy is consistently growing and less than 10% is shrinking, well, the net effect is that the economy, the middle between there being government spending, the net effect is that the economy has been growing over that period of time. And yes, making a plane 10% more efficient is important, but flying a plane 10% more efficient can actually have even bigger and more levered effects from an economic growth standpoint. So, from an overall economic situation, things look pretty good. If we go here to consumer, how is the consumer doing? Well, better than they ever have been. And I've gotten to say that every year I've ever done this presentation. It's beginning to become a bit of old hat. But let's zoom in here. Today, the U.S. economy, the U.S. Consumer, has about $197 trillion worth of assets, right? Homes, financial assets, deposits, other things. They owe about $21 trillion, mostly in mortgages, 2/3 of it in mortgages. So, rough math, almost 200 minus 20, a little under $180 trillion of assets. That's more than we've ever had. Okay. Now, what else is important about that? The U.S. consumer can continue to borrow. So if you look at this top chart, household debt service ratio, what percentage of your take-home pay goes to pay a debt? The answer is, except for COVID, when we all got paid to stay home and there was nothing to do, we're essentially at 45-year lows. We're pre-COVID levels. It's been fantastic. So if the U.S. consumer wants to borrow more money, they can. They have the availability to do so as a percentage of their household budget. What about delinquencies? You're going to read a lot about that because they're all up the past few years. Well, of course they are, because if you look at this chart, you can sort of see at the bottom, nobody had to pay student loans for 4 years. So we still had defaults, but why is beyond me. And those defaults shot up when people suddenly had to start paying them again. Well, that's a natural occurrence if nobody paid them for years. You imagine most people that had those hoping to get them paid off weren't saving the money or paying them down quicker. They were letting them grow or were spending the cash they should have been putting toward those things. But for autos, yeah, are they higher than they have in the past few years? Yes. Are they basically just slightly higher than pre-COVID levels? Yep. Same for credit cards and even mortgages. Yeah, mortgages are up a lot the last few years, but they're basically back to pre-COVID delinquency rates. So the U.S. consumer is in good shape. And they should be, because, the U.S. consumer broadly, and I'll cut back here for a second. The U.S. consumer broadly is defined as all consumers, but really right now only 10%, the top 10% of wage earners represent basically 50% of the consumer spending number. And you can put this in your mind, the bottom quintile of spenders, even if they get more money in their pocket, typically already have that money allocated for something, right? If you make a little bit more money, but you're already, living paycheck to paycheck, you don't tend to just go out and do wild new spending. The wealth effect really exists at the top 10%. And the top 10%, I just had this meeting last week. I asked people, what do you think it takes in the United States to be in the top 10% of wage earners? And I got all sorts of answers. The lowest answer was $350,000 a year. The actual answer, according to the IRS, is about $201,000 a year. If you as a family make over $201,000 a year in pre-taxable income, you are in the top 10% of wage earners, and you represent 50% of consumer spending. And I would argue those consumers should feel pretty good right now, because what do those consumers tend to have in common? They tend to own assets like stocks, which are all up. They tend to own homes, which are up. They tend to have jobs, which, jobs have been pretty plentiful as of late, even with some of the jobs numbers being a little bit higher. Let's not kid ourselves. This is a look back at unemployment and wages over since 1974, right? If you look here, the dark line is unemployment. October 2009, you had 10% unemployment. 2020 had 15% unemployment. Today we're at 4.6, right? That's November's number, but we're in the fours. We were in the threes a couple years ago, but other than basically Vietnam, you can't find a spot where you don't have a war where you have levels with a 3 in front of it. So the natural rate of unemployment, the lowest economists think we should be able to get to, is roughly 5%. We've been riding well below that for a long time. So when you say, yes, our joblessness up from a few years ago, of course they are. But historically, we run at about 6.1% unemployment. We're nowhere near that number. So for us, are we a little bit concerned about employment? Yeah, but most people have jobs, right? I mean, there have been administrations over years that have run on having 5% unemployment, and now we're at 4.6, and for some reason, some people frame it in the media as it's terrible. No, it's really in line. We had companies hoarding labor for years because they saw a coming labor shortage. We have pretty good employment at the moment. So the average U.S. consumer should feel pretty good. They've got more money in their pocket, and they probably have pretty good prospects for a job. Additionally, inflation. Now I'm going to talk about the Fed in a minute here. The Fed has a dual mandate. One is low and stable price increases, and the other one is full employment. They pretty much got full employment down. Now what about inflation? Well, let's go take a look at it here. Headline inflation as of December is running about 2.7%. I just want to reiterate that because when we were doing part of this presentation last year, inflation expectations were spiking upward, and the market crashed at the end of April, or at the beginning of April, because people thought we were going to have 6% inflation and permanent 4 or 5% inflation going forward. Those are the expectations because of tariffs. And we said at the time the tariff thing was a big deal, but it ultimately wasn't big enough to cause that kind of inflation, and it certainly wasn't big enough to cause a recession. Now, I ask most people today, what do you think about tariffs? Do you think they're rising, stabilizing, or possibly going down? And I think most people would fall into the camp that stabilizing to possibly going down is probably more likely. But just as we said it wasn't going to cause a recession, it wasn't going to lead to massive new inflation. Well, even if all the tariffs went away, it probably wouldn't lead to massive new deflation. It wouldn't lead to a massive increase in productivity somehow. If you go back to this chart, 18, 19, and 20, we had tariffs, right? That's that low. It didn't spike inflation back then. And we spent years at zero rates from 2008 basically to 2016 trying to get inflation. And if you take out rent equivalent yield, which is a metric that came out back in the 70s, which is that dark blue section of this chart, we almost didn't have any inflation for over a decade. Then we finally got inflation in 2021. But inflation is fundamentally, if you remember, a demand side phenomenon. It is too much money chasing too few goods. This was a supply side shock. People were buying cars, they had to go back and get the radios installed. They had to go back and get the badges put on later. Like, we physically just couldn't get stuff here. And the same thing happened in World War II. Everybody came home, but all the factories were made for planes and tanks, not for cars and houses and babies. So you couldn't just physically make that happen overnight. Well, there was a supply constraint. They just couldn't produce the right things quickly enough and in the right locations. You had massive spikes in inflation. The first 2 years, the troops came home in World War II. And then a few years later, inflation was basically back to 1%. Inflation is driven by more consumers wanting to consume more. The best way to get lots of inflation, and one of the things we look at, is demographics. If you have a lot of young people who want to buy more stuff, you tend to get lots of inflation because there's a big demand for their things. Well, we don't have that. We have a pretty straight demographic structure. It's almost one for one. Well, if somebody's looking to buy a house and sell a house, and I want to take the current housing market aside, but generally, people buy second homes in their late 40s, 50s, but they sell their second homes in their 80s. They want to purchase 4 or 5 bedroom homes and start a family in their 20s and 30s, but they've got all the kids out of the house and they're looking to downsize to a 2 bedroom condo, in their 70s. These are not unbelievable phenomena, but this is kind of the natural progression of things. So you tend to see people over the age of 65 tend to consume less as a percentage, and people under the age of 55, really that 25 to 55 demographic you hear advertisers talk a lot, they tend to consume a lot. So if you want big inflation, you want a lot of those consumers. Well, we don't have a lot of those consumers. It's relatively straight. It's almost one for one. It's also the reason inflation came down. Probably the Fed, raising rates was probably important to make sure inflation didn't get totally out of control. But at the same time, demographics were probably going to win this one. Inflation was going to have to come down because there's just not enough young new buyers clamoring for new things. Right? Even housing, we're talking about building new housing. We're building 500,000 homes a year. In the 1970s, we built 2 million homes a year and had half the population. Right? Because we had a rapid group of people entering that in the 1970s, you had all the baby boomers aging, and they rapidly needed new housing at a rate in which we'd never seen. And we, as the United States economy, met that demand. But let's get off of housing for a second and talk about what the Fed's going to do next. Is the Fed going to raise rates or lower rates? Well, they're not scheduled. Not scheduled. Doesn't appear as though they're ready to lower rates anytime soon. And Powell is out in May, where he's going to be replaced by somebody else. And right now, it seems like the current administration wants somebody who's relatively dovish, who wants to lower rates. And that is what the Fed is actually planning to do. If you look at this chart, there's the dark blue line. That is the FOMC year-end estimates. They expect to keep seeing rates lower over time. The purple is where they eventually want to get to. The green, which actually you notice goes down and then ticks back up, is what the market expects might actually happen. The Fed needs to be independent from the federal government. And the reason for that is because you've seen this happen other times where central banks are controlled by the government. And funny story, if you raise rates, it's harder for governments to spend money. Right now we spend $1 trillion in interest. If they raise rates further, we'll spend more on interest. If we lower rates, we'll spend less on interest. So no government wants high interest rates. And people, consumers, don't want high interest rates. Who wants a lower mortgage rate? Everybody. Right? So what do politicians typically want to vote for? Lower rates, even if that's not necessarily the right thing. So you do want the Fed to be independent, right? And they may need to lower or raise rates as they see fit. In the 90s, we said there's a soft landing. And the Fed was trying to engineer a soft landing this go around. They had a rapid raising of rates. That's our experience in 2022. Then they stopped. They went down a little bit. They went sideways for a while. And then as the market reaccelerated, i.e. the economy reaccelerated, they ended up having to raise rates again in the late 90s. Well, we might be sort of watching that same pattern. We went up, stopped, went down, and now we're watching maybe the market reaccelerate. And that's probably why the green lines are there, is they're expecting maybe the Fed is going to need to raise rates again in order to try to keep the economy from running too hot and burning out and causing a bigger recession. But overall, the economy looks incredibly strong. And what do we think is going to drive the economy forward from here? Well, remember before I talked about consumption is how I measure it? Well, let's go to the production side of it. How do you produce more? Well, there's only really 2 key ways to produce more. Workers and then their effectiveness per worker. And how do you get more workers? Well, if you want workers in the 20s and 30s, you better off have started 20, 30 years ago. Or you have to get comfortable with massive new immigration. In the 1970s, the blue section there, growth in workers, is the big driver of economic growth. Why? Because guess what? All the boomers from the late 40s, 50s, 60s Where now, suddenly, in the 70s and 80s, they were in their 20s, 30s, and 40s. They're coming into that period. So if you had a problem, you just threw more bodies at it because there were a lot of bodies. The flip side of today is we don't have that problem. We have less bodies. We've got that straight demographic structure, as I implied before. So you have to see growth in productivity in order to become a larger economy. We don't have a massive new labor force. If anything, we're seeing a bit of a labor shortage. But productivity is what drives the economy going forward. We are getting productivity gains. We've been telling this story now for over a decade that you can't even see. I mean, there's basic productivity gains as we measure them, but also, nobody gets lost anymore because of GPS. People miss less appointments because of digitalized calendars. Like there are, mail does not get lost in the idea of DocuSign. How many things we used to lose in the mail after resend? There's efficiencies that are just gained, and then they're basically permanently gained. Those efficiencies are very, very powerful. If you go back to the 1970s, the president at the time said they were very worried that Americans would become so efficient and so productive per worker that they would cut their work week from basically 5 days a week to 4, maybe 3, maybe 2 in the future. Well, and for human history, remember, nobody used to have breaks or a day off. Then it was very revolutionary to go to 6 working days. It was even more revolutionary to go to 5. So it seemed like that was the right trend. Well, let's go back to employers now. If I'm an employee, and we'll use some round numbers to make the math easy, and I make $100 an hour, and I work for 8 hours, right? Well, then I make $800 for the day. It's great. That's very, very, that's wonderful. But if I become much more productive, especially over a long period of time, and suddenly I make, you know, $800 in the course of an hour, right? What do people ask? Well, they say, well, you make $800 an hour. I mean, all I used to for an entire day. The employer says, well, then work the full 8 hours. You don't get to go home after one just 'cause you made the same amount. Well, let's work for the whole amount. If anything, I'll pay a little extra to stay late and make another $800 an hour. If we're working 9 and 10 hours, the incentive there because of the leverage is there. And this goes back to the manufacturing and services piece. If I'm 5% more efficient at manufacturing a plane, that's great. But if I'm 5% more efficient at utilizing it for the next 30 years, that's an even bigger net gain. So productivity is a real driver of economic growth. And this is where I want to finish up. Corporate profitability per employee has been surging. It's just never been higher. I'm not even going to zoom in on this chart because I think everybody can see it. All it does is seem to go up, right? And go up sort of rapidly. The average worker today is even more important than they've ever been, right? And that each hour worked is now even more important. So I know people are talking about replacements. That's not quite where we're at. Every hour worked is even more important. So they want to encourage more hours. And how do you get more hours? Well, the answer is immigration or more people. We're not really going to get that. So we're going to try to drive efficiencies out of that. The only way to get a bunch of people in their 20s and 30s to show up into the workforce, again, is to start 20 years ago, 20 or 30 years ago, or massive new amounts of immigration. The economic system overall, summing it back up, things look great. The economic picture looks fantastic. There's always a chance of recession. There's always a 20% chance of recession. There's always something we can't see coming, like another COVID that's just unpredictable. But barring something unforeseen, the economy is red hot. It looks fantastic. The U.S. consumer looks fantastic. The wage situation, employment, inflation look great. The Fed actually looks like it has room to do whatever it needs to do. And the economic drivers of growth are through productivity, which I think most people would argue we're getting more of those productivity tools coming forward. So from a conclusion standpoint, the economic structure looks very robust. But I'm going to switch over now to my father. We're going to talk about how this affects the markets and what this actually means for investing.
Hello, everyone. Great to talk to you again in 2026. I want to thank my son for going through our economic outlook. As you probably gathered, things look still pretty positive. There's a lot of momentum, a lot of tailwinds for the economy. That's good news. My part of the presentation is to talk about what we think the markets will do. And my big message here is caution. If I was a traffic light, I'd be blinking yellow. And why am I cautious? 3 big reasons, and you're going to see the evidence here later. Number one, we have a over concentration in the S&P 500 index, which most people think of as the market. And this concentration is a record concentration. Secondly, we have very high valuations. Valuations that are on the top decile, which is not a good place to start to make money. And third, we've had just a lot of good years in the last decade plus. And if you've taken a basic statistics class, they'll tell you there's a thing called reversion to the mean. You can't stay above average forever. Sometimes you gotta come back a little bit. Let's talk first about concentration. And this is a big issue. This goes back 4 decades, 1985 and 95, 2005, 15, and 25. It jumps right out at you right away. In the past, the top 10 companies in the S&P were 20% of the S&P 500 index. Today, we're 40%. Really have never seen that before. It's even during the dot-com bubble, we didn't have this type of concentration. Secondly, I want you to notice things change over time. 1985, they started in this graph by making all the companies green. You notice as time goes by, the greens go away. What it tells you is what is really working today is not necessarily working tomorrow or 10 years from now. So be careful of just, hey, these are great companies, I'll buy and hold forever. In fact, if you look at 1985, you'll notice 40% of the companies were energy companies. And by the way, we don't have it here, but if you went 5 years further back, 1980, it would have been 70% of the top 10 companies were energy companies. Energy was 27% of the S&P index. And the only thing you could buy and make money was energy. And a lot of money managers back then could not keep up with the S&P index because of that overconcentration of energy. By the way, just if anybody wants to guess, we went from 27% of the S&P index being energy down to today under 3%. Tells you that back then people thought energy, oil was going to $200 or $300 a barrel. It's the only thing that made sense. The other period of concentration was 2005. If you look at that closely, half those companies are financial companies. And if I'd say 2 years later, it was even higher than that. What happened from 2005 to 2010? A financial collapse. So owning financial companies was not a great place to be. So a lot of those financial companies went down. That was an overconcentration that hurt your performance. Take us today. Top 10 names, a lot of technology in there. This is a problem. All money managers out there are having trouble keeping up with the S&P 500 index because, quite frankly, if you're a fiduciary and managing people's money in a prudent manner, you can't overweight your portfolio to just these 10 stocks, or really just the bottom 6 or 7, which are 30% of the market. That isn't the right way to manage money. And our job is to preserve capital in the long run. So this has been a problem, but as you've seen in the past, it does change and it will end. And over the next 3-4 years, I would wager 2 or 3 of these companies fall by 50%, because that's what happens when you have this overconcentration. Which ones? I don't know. Probably the more, I would say, chip-related stocks are probably at the most risk. But we don't know, and they can keep running for a long time. Let's talk about how good the market has been. And this chart, we brought it up every time we do our presentation. Wow, have we had a run for the last 15 years. This has been a phenomenal market over time. If you go back, the S&P was at 1,000. Now we're 7,000. That's fantastic long-term returns. And we couldn't be more happy. The reason we got these great returns, in our opinion, was the prior 15 years, basically 97 through 2012, was a period of stagnation. It was a secular bear market which means you go sideways for years, you really make no money. In fact, we had two 50% declines during that period. The dot-com bubble was responsible for the first one. The financial collapse was responsible for the second. But it set us up for outsized returns. And O'Hare Wealth Management back in 2012, 13, 14 was telling our clients that, hey, we're in a new secular bull market. Those usually last a decade or two, and we're going to have outsized returns. It's been correct. But we are, 12, 13 years into it. Are there 3 years left or 6 years or 7 years? I don't know. I think there is more left, but I am a little bit concerned. And one of the concerns is our next chart, which is valuations. Now, over time, this is a valuation chart looking at the S&P 500. Right in the middle, in fact, make it big for you, right in the middle, the 30-year average is 17 times earnings. What does that mean? That's a PE ratio. PE ratio is very simple. People think it's confusing. If I put $17 in a bank account or a savings account and I get a $1 return every year, I'm paying 17 times for that $1. If you do the math on that, that's about a 5.5+% return. That's not unreasonable to expect. So as I pay more, like 20 times, now it's 5% return. And if I pay 24, 25 times, now it's 4.6% return. You see the math here, the returns are getting lower. We are well above average. And the last time we were well above average for a long time was the dot-com bubble, and it ended very, very poorly. The S&P fell 54% and the NASDAQ fell 82%. Recently, in the beginning of 2022, we told clients the market was very overvalued and it was going to be a risky year to make money. We predicted 22 would not be a good year for the market. We had no idea that would be a bear market because we didn't predict Russia invading Ukraine, and we did not predict the Federal Reserve raising rates faster than they had done in history. So we got a bear market. Guess what? PE ratios fell under 17 times. Great time to buy stocks again. And we've made a lot of money since then. But starting at this level again, it's going to be a little difficult to make money. So we've got the concentration risk, we've got the valuation risk, and we've got the fact that it's been good for a long time. So we are cautious. This chart is not an eye test, but it gives us some interesting historical data. And this goes back basically a little over 30 years. On the right-hand side, see the red diamond? That's roughly where we're at today, 22 times earnings. It's actually like 23 and a half now. But the dots, the black dots, are your annualized returns 1 year later. And you notice with that diamond, if in the last 30 years, if you had bought the S&P 500 index at 22 times earnings, you can see a lot of the dots are above zero. You annualized at 15, 10, 20, even 25%. And there's a lot below where you had annualized losses, down 20% or more. But you notice there's not a very clear pattern on the left side of the chart or the 1 year chart. When you take 5-year returns, you notice there's a much higher correlation. Not perfect correlation, but it is a guide. Most of the times you buy the market at 22 times earnings. 5 years later, you've made money a few times, but most times you've lost money. And if you move that 22 over to 24, 23 and a half, 24, last 30 years, you've had negative returns. It looks like 100% of the time based on that chart. So that's a scary position to be in. Now, I'm not trying to just scare you and tell you everything's bad. There's some very good things going on that could give us support in the market. And the big thing is earnings. Earnings is the most important thing for stocks. There's a correlation for stocks and earnings long term. I'm going to come back to that. Long term, if earnings go up, stocks go up. It's almost 100% perfect correlation. And there are expectations for earnings going up. Last year, 2025, the market had 11% earnings growth. That's the S&P 500. Estimates out there now are for 15% growth. And you've got 15% growth in 2027. And look at the right-hand side. Corporate margins are at records. That's one of the reasons the market's at record highs. The companies are doing very, very well. The concern is, will margins stay at records and will the earnings come through as expected? And let's just look back at the 25-year average. The EPS growth is driven by three things: margin expansion, revenue growth, and share count, either more shares issued or more shares bought back. You look at 2025, we had great margin expansion, 6.7%. We had good revenue growth, and we actually had a little bit of excess share count. But really, look at margins versus the 25-year average. The expansion's been 2.2%. The revenue, it's above average. But that long-term trend shows you that total EPS growth has averaged 7.3% over 25 years, and it was 11.5. And we expect it to be 15 and 15 for the next 2 years. It definitely could happen. And the companies out there with the AI boom and the top 10 companies being a lot of technology companies with good profit margins, this could happen. It's just one of those things that at this stage, it better happen, or it's not going to be good for us. Back to the point about earnings. So long term, look at this chart. The correlation is 0.97. 1.0 is perfect. So this is 97% correlation. The S&P index, the dark line, and the S&P earnings follow each other. So if you believe S&P companies, which are a lot of great American companies, if you believe their earnings are going to grow over the next 10 years, then the S&P index is going to grow. Doesn't mean it's going to grow next year. Doesn't mean we couldn't have 2 years of it going down. In fact, after the bubble in 99, we had 3 years of the S&P going down, and earnings had gone down as well. But long term, it's still a positive. We still want to own stocks on a long-term basis. The next question is, John, you sound so bearish. Are we going to have a nasty correction this year? Well, number one, we're going to have a correction, because this chart over 40 years shows you, even though you can have up years, and the gray bars are the year-end results for the market, the red dots are the intra-year or declines we saw during the year. Look at the far right in 25. We had a 19% decline. Basically a bear market in April when they announced the tariffs. We still ended up 16% plus. So you can have big declines during the year and still have positive years. The average intra-year decline is 14%. So if you say we're going to have a decline this year of 14 to 15%, it certainly would be average. Last year was above average. It was 19%. A couple of years earlier, it was only 8%. But it will happen. There will be a correction in the market. That could be an opportunity to add to the markets. But expect it. Don't be surprised by it. Let's talk a little bit about the federal budget. And I bring this up because it is another concern I didn't mention in the beginning, but I get asked about it all the time from clients. And for those of you who are not familiar with how the budget works, this is the federal budget. The left-hand side is spending. The right-hand side is how you finance that spending. You notice there's a big dotted white box that says deficit. That means you have to borrow that every year. So 25% of what we spend, we have to borrow. And that's not a good thing. If you're a household, you wouldn't like to have to borrow 25% every year for what you spend. The problem with the spending is, if you look at the left-hand side, is the bottom half, Social Security, Medicare, Medicaid, which is well over half the spending, it's automatic. it's going to go up. And quite frankly, you would need a major change in the attitude of politicians to address that spending. Right now, the spending on both of those is going to go up probably above the inflation rate. Medicare will for sure. Social Security will go up with the inflation rate. So it's got to go up. On top, all other spending, 17%, that's all the other departments the government has. You might be able to cut a little bit there. If you could keep it flat, it would be helpful. And look at the next box, net interest. It's $1 trillion now, 14% of our spending. That's because we have not just the yearly deficit, our total debt owed is over 30 plus trillion. We have to pay the interest on that. So lower interest rates would be welcome for the federal government. It would lower some of their spending. Defense at almost $8 trillion or 13%. The current administration wants to raise that by 50%. They want another $500 billion in spending. I don't know how you do that with the deficits you already have. But right now, I don't see any change in the direction of federal deficits and interest payments. Looking at this graph, I don't go way back into the late 90s. We actually had a surplus for a little while, which was a nice thing to have happen. And then we had the financial crisis, which caused our deficit spending to go up. Those are negative numbers on top. Negative means it's a deficit. We spent more than we had. Then we had COVID come in, and it went even higher. It came down from there, but it's projected to stay at 6% deficit every year. That is going to be a drag on the economy. And here's the total debt. The first chart was the yearly deficit. This is total debt. And we're on our way. We're basically at 100% debt to GDP, which is not a good thing. There are lots of developed countries like in Europe and Japan where their deficits are much, much higher. This doesn't mean we're going to hit a wall and everything's going to fall apart. What it does do is it becomes a drag on the economy, and it hinders our ability to react to things that are going wrong. If there's another COVID, or quite frankly, if there was another world war, look back way back in the 40s, our deficit got up to 100% because we were fighting World War II. Then it went down for years as our economy grows. We need the spending to slow, and we need our economy to grow faster. That's how you fix this over time. But not a great thing. Another reason to be slightly concerned. We're not going to talk about the US dollar a lot today, but the decline in the US dollar is partially a result of this debt buildup. And that's not a good thing long term. And we'll have another conversation that at some point. What do we do? There's two things we do. First is most of our clients don't own just stocks. They own stocks and bonds and possibly some other alternatives. The first most important thing you can do, if you had a 50-50 portfolio, 50% stocks, 50% bonds 3 years ago, guess what? Stocks are up so much, that could be 65% stocks. What should we do? We should sell stocks. We should sell stocks and buy bonds. You should reallocate, or what we call rebalancing. And you should do that when the market's been too good for too long. You should also do that like in 2022 when the stock market fell 25% at the bottom. You should have been buying stocks and selling some of your bonds. I will tell you, that is academically and theoretically the right thing to do. But it's the hardest thing for people to do when it's happening. But we are doing that as a regular basis. We try and rebalance accounts at least on an annual basis. The other thing you should do is look at things that aren't stocks and might act differently than stocks. And this is further diversification. And we're going to do a little video on this, probably 15, 20 minutes, just on alternatives. We'll be publishing that sometime in the next couple of months. But if you look at this chart, these big bubbles, it shows you on the bottom, very importantly, trailing 10-year correlation. Correlation means do they move together or do they move separately? If it's a 1-to-1 correlation, that's a perfect correlation. Look at the far right, 1.0, perfect correlation. If you have a 60-40 stock bond portfolio, it's perfectly correlated to the stock and bond market. But notice if you just slide over a little bit, private credit is a 0.6 correlation. That means it's 40% less likely to follow the stock and bond market. Infrastructure is almost not correlated. It's under 0.2%. You can invest in infrastructure. We have alternative investments out there where you can buy into companies that buy power lines, distribution lines. They buy airports, bridges, waterways, wind farms. These are long-term contracts, and people have to pay these bills every year, regardless of what the stock market does. Way over on the left, you notice real estate is negatively correlated. Typically, long-term, real estate does not follow the stock market. So adding some of that to your portfolio is probably a very good idea. And that's something we will consider, but we have to talk to everybody individually to make those decisions. I'm going to wrap this up by saying, listen, we're cautious, we're concerned. We have concentration issues, we have high valuations, we've had historically high returns, we got a federal government that can't stop spending. But remember, long term, you always are going to have stocks in your portfolio. Why is that? Well, even if you're retired today and withdrawing 5% a year, you're going to withdraw that over 20, 25 years. So half of your portfolio and possibly more will be in the stock market for 20 years. And as this graph shows you, on a 1-year basis, you can lose a lot of money or make a lot of money in the stock market. We don't look at 1 year, we look at 5 years or longer. On a 5-year basis, if you look at stocks, the green bar, or bonds, the blue bar, or a mix, 60-40, on a 5-year basis, your annualized returns are almost always positive. On a 10-year basis, your bond returns have always been positive for your portfolio, and even a 60-40 portfolio has always been positive. I should say historically. This goes back 75 years to 1950. 20 years, stocks, bonds, and a mix have always been positive. Again, part of your portfolio will be around for at least 10 years, maybe 20 years. So we don't run away from stocks because we have concerns. We might rebalance and own a few less stocks, but overall, we have to maintain a position in there. And part of our job as fiduciaries is to preserve your capital. And we are not going to overly concern ourselves about keeping up with the indexes on a short-term basis when we have all these concerns. We're more concerned about when things go wrong, like after the dot-com bubble or after the housing bubble, is preserving your capital. So with that, we're going to wrap it up by saying, hey, send us your questions. Let's get together individually with you and talk about what's going on in your portfolio and have some discussions on what's going to happen this year.